So I want you to picture this. A few years ago, there was this highly secretive proprietary trading firm, right?
Oh, yeah, the tunnel guys.
Exactly, the tunnel guys. They literally spent roughly $250 million to blast a tunnel straight through the Allegheny Mountains.
Which is just, I mean, it's insane to even think about.
Right. They terraformed the Earth just to lay a perfectly straight fiber optic cable. And this was between a data center in Chicago and a stock exchange in New York.
And what was the actual time they saved by doing that?
That is the craziest part. The entire purpose of this massive multi-million-dollar infrastructure project was to shave exactly 1.4 milliseconds off their transmission time.
1.4 milliseconds.
Yeah,
wow.
1.4. I mean, to put that in perspective for you listening, a human blink takes about 300 milliseconds.
Right, so we can't even comprehend that speed.
Exactly. So if you're sitting at home, looking at your retirement account, wondering why your portfolio isn't doing what you think it should or why you feel like you're just constantly a step behind in the market, it's because that is the battlefield you're stepping onto.
It is an incredibly sobering reality, honestly. We all operate under this persistent, somewhat romantic illusion.
The mom and pop investor illusion.
Yeah, exactly. We think the financial markets are this level playing field where, mom and pop can sit down at the kitchen table, read a company's annual report, and somehow outsmart Wall Street.
Right, like it's 1950 or something.
But the reality is that the modern financial ecosystem is completely designed to extract wealth from the uninformed. It's an environment dominated by algorithmic trading, asymmetric information, and these highly complex financial instruments designed to obscure massive hidden costs.
And that is exactly why we are here with you today for this deep dive. We are taking a machete to that exact jungle.
Love the machete analogy. We need it.
Oh, absolutely, because our mission today is to unlock a master plan for financial freedom. We're talking about a strategic blueprint that historically has been reserved almost exclusively for the ultra-wealthy.
Right, the family offices, the institutional titans.
Exactly. We are tearing into the core concepts from Tony Robbins' massive text, Money Master the Game. And I want to be clear right off the bat, because I know that name carries a certain weight in the personal development space.
Yeah, people hear the name and think of like jumping on trampolines and yelling.
Right. We are not talking about firewalking or standing in front of a mirror reciting daily affirmations to somehow manifest a bag of cash.
Exactly. This isn't about the psychology of positive thinking at all. This is a rigorous synthesis of actual hard financial strategy.
And the sources for this are just incredible.
They really are. The underlying source material here isn't just one author's opinion. It is the distilled output of exclusive, incredibly candid interviews with 50 of the most brilliant financial minds on the planet.
We are talking self-made billionaires, Nobel laureates in economics, the founders of the largest asset management firms in human history.
Yeah, people like Ray Dalio, Jack Bogle, Paul Tudor Jones. We have a massive stack of sources in front of us today, ranging from deep dives into behavioral neuroeconomics to a complete structural breakdown of the modern financial system.
And our goal is to synthesize all of this data into a highly actionable blueprint for you. Yeah. Because, we know you want to optimize your wealth, navigate all these crazy complexities, and achieve true, mathematically sound financial independence.
But to really understand this blueprint, we have to look at the historical context of when this material was compiled.
Right. The timing is crucial.
It is, because the tone of this entire strategy is incredibly defensive, and that stems directly from the trauma of the 2008 global financial crisis.
Which was, the most catastrophic economic meltdown since the Great Depression.
Absolutely. During that period, we saw average hardworking Americans lose half their net worth. They lost their homes, their pensions, their entire sense of security. Trillions of dollars in middle-class wealth just vanished.
But not for everyone.
No, not for everyone. If you look at the upper echelon of the financial sector, the insiders, the hedge funds that actually understood the mechanics of the mortgage-backed security collapse, many of them didn't just survive.
They made a killing.
They generated historic profits. The system is fundamentally designed to protect the house. So the overarching theme of this deep dive is about recognizing that asymmetry and changing your posture.
From a consumer to an owner.
Exactly.
Yeah.
You have to transition your mindset from being a mere consumer within the economy to becoming an actual owner of the economy.
I want to push back on that a little bit, though.
Yeah.
Because, you just laid out the reality of those insiders, right? The firms terraforming mountains for a millisecond edge.
Yeah.
The guys running supercomputers that execute 50,000 trades before I can even open the app on my phone and click buy.
It's intimidating.
It's beyond intimidating. If 50 to 70% of daily market volume is high-frequency algorithmic trading, why should the average person even step onto this battlefield? If the game is that violently rigged, isn't the most logical move to just, take my chips off the table, buy some real estate, or just hold cash?
It's a completely logical reaction, and honestly, it's exactly what millions of people did after 2008. They went straight to cash.
Which feels safe in the moment.
It feels safe, but in doing so, they completely missed out on the greatest, longest bull market in American history. To answer your question, we really have to look at what Ray Dalio says about this exact dynamic.
And just for context, Dalio founded Bridgewater Associates.
Right, the largest hedge fund in the world. He manages money for sovereign wealth funds and massive pension systems. He has thousands of employees, functionally limitless computational power.
He's the guy terraforming the mountains, basically.
Pretty much. And when he's asked how the average investor can beat the market, his answer is startlingly blunt. He says, you don't want to be in that game.
Wow. The guy who literally runs the game is telling us not to play.
Precisely. Because active trading, trying to pick the right stock at the right time, or outsmarting those high-frequency algorithms, is a zero-sum game.
Meaning someone has to lose for someone to win.
Exactly. For you to generate what Wall Street calls alpha, or excess return above the market average, someone else on the other side of that trade has to generate negative alpha.
Right.
And the entity on the other side of your trade is likely a supercomputer housed in a data center in New Jersey, trading on information you won't see for another 10 minutes. You just cannot win a zero-sum game against an opponent with infinite resources.
So, if we aren't trying to beat them, what are we doing?
We are embracing passive participation. The secret isn't beating the casino. The secret is owning the casino.
Owning the casino. I love that phrase.
Yeah. You don't walk into the Bellagio and try to bankrupt the house by outsmarting the dealer at the blackjack table. The odds are mathematically engineered against you from the start.
Right. The house always wins.
But if you own shares in the casino itself, you benefit from the aggregate structural reality that the house always wins over time.
So in financial terms, what does that actually look like?
It means capturing the overarching beta, the natural upward trajectory of global economic growth and human productivity. Instead of trying to actively dart in and out of individual positions faster than a fiber optic cable.
It fundamentally reorients how you view the stock market. You aren't, placing bets on a roulette wheel. You are purchasing a fractional share of human innovation and corporate profitability.
Exactly.
But to even get to the point where you are buying that share, you have to cross a massive psychological threshold. And this is where the sources get into the concept of the freedom fund. Because frankly, earning a high salary is entirely distinct from actually building wealth.
It is the most critical distinction in personal finance, and one that highly educated, high-earning professionals consistently get wrong.
Oh yeah, we all know doctors who are broke.
Exactly. The economist Burton Malkiel is cited extensively on this point. He highlights a brutal mathematical truth. Earning your way to wealth is functionally impossible for 99.9% of the population.
Because there's a ceiling on your time.
Right. You cannot trade your time for money at a high enough hourly rate for enough hours in the day to generate generational wealth. Time is finite, and you have to pay taxes on every dollar you earn.
So what's the mechanism that breaks that ceiling?
The only mechanism that escapes the limitation of time is compound interest. You have to transition from a paradigm where you work for money to a paradigm where your money works for you.
Which sounds great, right? The math of compounding is something we all learn in high school. We all nod our heads, and then practically no one actually utilizes it effectively.
It's true.
We all know that saving is good. We know that if we put money away, it will grow. So why don't we do it? If the math is undefeated, why is the American savings rate just persistently abysmal?
That is the million-dollar question.
And this is where the behavioral economics in these sources completely blew my mind. Because it exposes the fact that our biological hardware is actually completely incompatible with modern financial planning.
We are operating a 21st century financial reality using software that evolved on the Pleistocene savanna.
That is a great way to put it.
The sources rely heavily on the work of Dan O'Reilly, a pioneering behavioral economist. He uses visual illusions as a metaphor for our cognitive biases.
Oh, the table illusion. Explain that one. So good.
Right, so he shows images of two tables that are mathematically identical in length and width. But because of the surrounding visual context, the angles of the legs and the shading, our brains completely refuse to see them as equal.
Even when you know the trick.
Even when you place a ruler on the page and prove they are identical, your brain still processes one as longer. Ariely's point is profound here. If our cognitive hardware can be so easily, repeatedly fooled by simple geometric lines on a page, imagine how wildly inept we are at intuitively processing highly abstract, nonlinear concepts like compound interest over a 40-year time horizon.
We quite literally do not have the neural pathways for it.
You don't.
And the most incredible manifestation of this biological mismatch is the monkey and apple study. Let's talk about the neuroeconomics of loss aversion, because this explains why budgeting feels like absolute torture to most people.
Oh, this study is fascinating.
So researchers took a monkey and gave it an apple. The monkey's brain registers a massive dopamine spike, right? It is demonstrably thrilled.
Just a happy monkey with an apple.
Exactly. Then they take a different monkey and give it 2 apples. Again, massive excitement. But then they introduce the variable. They approach the monkey with 2 apples and they take 1 away.
Now, objectively, this monkey still has 1 apple. From a pure utility standpoint, it is in the exact same economic position as the first monkey, who is perfectly happy.
Right. But the monkey who had an apple taken away completely loses its mind. It exhibits extreme distress and anger.
It goes ballistic.
Yeah, its brain doesn't register the absolute value of possessing 1 apple. It registers the severe trauma of losing an asset it believed it owned.
This is the biological reality of loss aversion. Nobel laureate Daniel Kahneman proved that the psychological pain of losing $1 is roughly twice as intense as the psychological pleasure of gaining $1.
And this translates directly to our paychecks.
It really does.
When you sit down and decide, okay, I'm going to divert 10% of my current income into a retirement account, your logical brain says, I am securing my financial future. But your amygdala, your primitive monkey brain screams, you are taking an apple away from me right now.
Yes. It registers the act of saving as a severe, immediate physical loss. You acutely feel the pain of the dinner you can't buy or the vacation you have to delay.
Which perfectly explains the systemic retirement crisis in this country. Human nature dictates that if an action causes immediate psychological pain for some delayed, abstract reward that we might not see for 3 decades, we will simply avoid the action altogether.
Willpower is a depreciating asset. You cannot rely on it for 40 years.
So how do we bypass our own biological limitations?
The sources highlight a revolutionary behavioral program designed by economist Shlomo Benartzi. It's called Save More Tomorrow.
This program is such a brilliant hack of the human brain. How exactly does it circumvent that monkey brain loss aversion?
It separates the decision to save from the immediate financial impact. Instead of asking you to take a pay cut today, which triggers the loss aversion, the program asks you to commit a percentage of your future pay increases to your savings.
Oh, I see.
So you agree today that when you get your standard 3% cost of living raise next year, 2% of that raise will automatically be diverted into your investment account, and you will take home the remaining 1%.
So you never actually see your paycheck go down.
Exactly.
You never experience the loss of the apple.
That's the genius of it. Your take-home pay still goes up slightly, so your brain gets a small dopamine hit of a reward, but the bulk of the new money is instantly captured for compounding before lifestyle creep can set in.
Because if you see it in your checking account, you're going to spend it.
100%.
Yeah.
And because it is automated, it requires absolutely no ongoing willpower. You make the decision once when you are in a cold, rational state, and the system executes it automatically in perpetuity.
It's about engineering your environment so that the path of least resistance leads to wealth accumulation rather than consumption.
Exactly.
All right, so let's assume you've implemented this, right? You've hacked your psychology, you've automated your future raises, and over the years, a significant pile of capital starts accumulating in your freedom fund.
The plan is working.
The plan is working, and this is where the narrative usually stops in mainstream financial advice. They just say, just save. But the sources argued that the moment you build that pile of money, an entire industry of highly credentialed professionals is waiting in the wings to systematically drain it.
And this is where we have to transition from behavioral psychology into the harsh structural realities of Wall Street. The premise here is that if you do not understand the rules of the financial services industry, you will become its primary yield source.
You become the product.
Yes. The financial sector is incredibly adept at creating what we call asymmetric information environments.
Which means what exactly?
It's a space where the complexity of the product is intentionally designed to obscure the true cost to the consumer.
The sources outline several myths that Wall Street relies on to separate you from your capital. But I really want to dive deep into the most pervasive and destructive one first. The illusion of active management and the devastating mathematics of hidden fees.
This one is huge.
We are sold this narrative that if you want to grow your money, you need to hand it over to a star mutual fund manager, right? A guy in a Brioni suit who went to Wharton and spends 80 hours a week analyzing balance sheets so he can pick the winning stocks and dump the losers before the market crashes.
It's an incredibly seductive narrative because it maps onto how we operate in literally every other area of our lives. If you have a complex medical issue, you hire a highly trained specialist.
Right.
If you have a complex legal issue, you hire an expert attorney. Therefore, it feels entirely intuitive that if you have complex financial goals, you should pay a premium for an expert mutual fund manager to actively trade your portfolio.
But the data completely obliterates that intuition, doesn't it? I mean, it's not even close.
It is a statistical bloodbath. When you look at the performance of actively managed mutual funds over a sustained long-term horizon, say 15 to 20 years, roughly 96% of them fail to outperform their benchmark index.
Like 96%?
96%. That means if you just threw darts at a board with the S&P 500 on it, or bought a passive index fund that simply mimics the entire market without doing any research at all, you would beat 96% of the highest paid, most highly educated financial professionals on earth.
That is wild. I mean, if my surgeon had a 96% failure rate, I would be dead. If my mechanic failed to fix my brakes 96% of the time, I would be in a ditch.
Exactly.
But in finance, we have normalized paying exorbitant fees for overwhelming failure. And let's talk about those fees, because this is where the real theft occurs. I love the analogy the author uses here, comparing your investment portfolio to a boat.
The leaky boat analogy is perfect for visualizing compounding costs.
Right. So you are in this rowboat, trying to row across the ocean to the shores of financial independence. You're rowing your heart out. That is you working 50 hours a week, denying yourself luxuries, carefully automating your savings.
Well, putting in all the effort.
You are generating the momentum. But your boat has a leak in the hull. And that leak is the management fee charged by the mutual fund.
And the really insidious nature of that leak is how small it appears on paper.
Exactly. The broker hands you the prospectus and says, look, our expense ratio is only 1%, maybe 1.5%. And your brain, which is anchored to things like a 7% sales tax or a 20% credit card interest rate, thinks, well, 1% is nothing. I get to keep 99%. That seems like a totally fair trade for this guy's expertise.
But that fundamentally misunderstands how investment fees are calculated.
It's not a tax on the gains, is it?
No, it is perhaps the most catastrophic misunderstanding of math in the modern American middle class. That 1% or 2% fee is not a percentage of your profits. It is a percentage of your entire total asset base, and it is extracted every single year, regardless of whether the fund manager actually made you any money.
So even if I lose money, they get paid.
Exactly. If the market goes up 10%, they take 2% off the top of the whole pile. If the market crashes 20% and you lose a fifth of your life savings, they still take 2% of whatever you have left. Wall Street participates entirely in your upside, but takes absolutely zero of your downside risk.
I really want to dig into the research on this because it gets even worse. The sources cite a massive PhD study conducted by Robert Hilton Smith regarding the true cost of 401k fees. He found that it isn't just the visible 1% expense ratio printed on the brochure. There is a whole shadow economy of fees going on beneath the surface of these funds.
Hilton Smith's research was genuinely groundbreaking. He cracked open the actual accounting of these funds and found up to 17 different hidden fees that are legally passed on to the consumer without explicit, transparent disclosure in the marketing materials.
17 hidden fees? Like what?
We are talking about marketing fees, often called 12B1 fees, where you are literally paying the mutual fund to run television commercials to acquire more customers.
Wait, I'm paying for their marketing?
Yes. There are redemption fees, administrative record-keeping fees, and incredibly opaque things called soft dollar costs.
Okay, stop right there. Explain soft dollar costs, because that sounds like institutional money laundering. How does that actually work?
It is essentially a legal kickback system. When a mutual fund manager executes a trade buying or selling a stock, they have to use a brokerage firm to process that transaction. The broker charges a trading commission. Under soft dollar arrangements, the broker charges the mutual fund an artificially inflated commission for the trade, and in exchange, the broker provides the mutual fund manager with free research, software terminals, or data analytics.
But who is actually paying that inflated trading commission?
The mutual fund passes that cost directly onto the individual investors within the fund. It reduces your net return. You are silently subsidizing the fund manager's operating expenses, and it doesn't even show up in the headline expense ratio.
That is unbelievable.
Yeah.
So when you aggregate all of this, the expense ratio, the 12b-1 fees, the soft dollar costs, what is the actual mathematical impact of this leak in the boat over a 30-year investing lifetime?
The math is terrifying because of the inverse power of compounding. Just as compound interest accelerates your wealth exponentially, compounding fees accelerate the destruction of your wealth. Over a 30-year investing horizon, the difference between paying a 0.5% fee and a 3% fee doesn't just reduce your final balance by 2.5%.
Right, because you lose the growth on the money they took.
Exactly, because you are losing that capital every year and losing all the future compound growth that capital would have generated. A 3% total fee burden can legally siphon off 50 to 70% of your potential future nest egg.
I want everyone listening to stop and actually process that. You go to work for 40 years. You trade the prime hours of your physical life for a paycheck. You sacrifice current consumption to save. You take 100% of the market risk. And when you finally reach retirement, Wall Street has engineered a system to legally expropriate 50 to 70% of the total wealth you generated, simply as a toll for managing the paperwork.
It is wealth extraction on an industrial scale. Hilton Smith's study quantified this in dollar terms. For the average dual-income American household, these hidden fees drain anywhere from $154,000 to over $277,000 from their final retirement balance.
That is a paid-off house. That is a decade of dignity in retirement, just gone.
Yep.
So the actionable mandate here is crystal clear. You have to aggressively plug the leak. You cannot row fast enough to outpace a 3% drag. And the solution the sources unanimously point to is the low-cost index fund, championed by Jack Bogle and Vanguard.
Instead of paying a manager 3% to guess which stocks will win and being wrong 96% of the time, you pay an index fund something incredibly minuscule, like 0.004%, to simply own a microscopic fraction of every single company in the S&P 500.
You eliminate the active manager, you eliminate the trading costs, you eliminate the 12b-1 marketing fees, and you guarantee that you will capture the exact return of the broader market. You plug the leak, and suddenly you are keeping 99.9% of the growth your money generates.
It's the most rational move an investor can make.
But this revelation creates a huge point of friction for a lot of people. Because if we accept that the active mutual fund manager isn't adding value and is actually destroying wealth, the natural instinct is to seek out one-on-one professional guidance, right?
Sure, you want an expert to just tell you what to do.
Exactly. You think, okay, I won't buy the mutual fund directly. I'll go down to my local bank branch, or I'll call up my friendly neighborhood financial advisor and have them build me a portfolio.
But this leads us to an incredibly vital legal distinction that most Americans don't even know exists.
It is the most important legal distinction in retail finance, the difference between a broker and a fiduciary.
I love the analogy used here. It's the difference between talking to a butcher and talking to a dietitian. Break down how the legal standards apply to this.
Most people assume that anyone who calls themselves a financial advisor, a wealth manager, or a vice president of investments is legally obligated to give them the best possible financial advice. But that is fundamentally false. The vast majority of these professionals operate under a legal framework regulated by FINRA as brokers.
And what does that mean legally?
A broker is, by legal definition, a salesperson representing a broker-dealer. And brokers are held only to what is called a suitability standard.
What does suitability actually mean in a court of law? It means that the investment product they sell you simply has to be suitable for your general age, income level, and risk tolerance. It does not mean it has to be the best product for you or the cheapest product for you.
Hence the butcher analogy. You walk into a butcher shop and ask, what should I have for dinner?
Yeah.
The butcher is always going to recommend the most expensive cut of meat they have in the display case. They are not evil. They aren't malicious. They are simply acting rationally within their incentive structure.
Exactly. They make money by selling meat. They are never going to tell you to go home and eat a salad, even if your cholesterol is through the roof.
So how does that play out with a broker?
A broker under the suitability standard can look at two investment products. Product A is a low-cost Vanguard index fund that charges 0.04% and pays the broker zero commission. Product B is a proprietary mutual fund created by the broker's own company that charges you a 5% upfront load fee, a 2% annual expense ratio, and pays the broker a massive cash commission and a trip to Hawaii.
And they could just sell you product B.
Under the suitability standard, as long as product B contains stocks appropriate for your age, it is perfectly legal for the broker to sell you the hyper-expensive product B instead of product A. They are legally allowed to put their financial interests ahead of yours.
Which is mind-blowing. So what is the alternative? Who's the dietitian in this scenario?
The alternative is a fiduciary, specifically a registered investment advisor, or RIA. Under the Investment Advisors Act of 1940, a fiduciary operates under the highest standard of care in the law.
Like a doctor.
Exactly like a medical doctor taking the Hippocratic Oath, or an attorney bound by client privilege. A fiduciary is legally mandated to place your financial interests above their own. They cannot accept hidden commissions, they cannot take kickbacks from mutual fund companies, and if they recommend product B when product A is cheaper and better for you, they can be sued and lose their license.
They are the dietitian. You go to them, pay them a flat fee for their time, and they evaluate your entire financial health. If the best answer for your portfolio is to buy cheat index funds, that is what they're legally required to prescribe, because they don't get a commission either way.
Exactly. The takeaway here is non-negotiable. If you are seeking financial advice, you must ask the person in writing, are you a legally bound fiduciary at all times? If they hesitate or say they are duly registered, you run out the door.
Because if they are duly registered, they can take their fiduciary hat off and put their broker hat on whenever it's convenient to sell you a high-commission product. You want a fee-only fiduciary, full stop.
Full stop.
Okay, so we've fired the butcher and hired the dietitian. But what about the money that is locked up at our jobs? Because this was another massive illusion shattered by the sources. We've been conditioned to view our corporate 401k plan as this sacred, impenetrable safe harbor, right? The HR department gives you the packet, you sign up, and you assume it's optimized.
But the realities of the modern 401k system are brutal. The 401k is actually a fascinating historical accident. It was never designed to be the primary retirement vehicle for the American middle class.
Really? What was it for?
It was created in 1978 as a loophole in the tax code, literally Section 401, subsection K, designed to give highly compensated executives a way to defer taxes on their bonuses.
Wow, so it was just an executive perk?
Exactly. But corporate America quickly realized that if they transitioned the entire workforce into 401k, they could entirely dismantle the extensive corporate pension system and shift 100% of the investment risk onto the employee.
It was a massive transfer of liability. And because the employers aren't the ones paying the investment fees, they often don't aggressively negotiate the costs of these plans.
That's the kicker. The tax advantages of a 401k, getting an employer match and deferring income taxes, are very real and should absolutely be utilized up to the match. But the structure itself is often deeply compromised. The sources reveal that many corporate 401k plans, especially at smaller companies, layer on plan administration fees of 1.13% to 1.5% just for the privilege of participating in the plan.
And that fee is charged on top of the expense ratios of the mutual funds inside the plan.
Yes. So you could be paying 1.5% to the plan provider and another 1.5% to the mutual fund, putting you right back into that 3% death spiral where Wall Street takes half your wealth.
In some of these truly predatory high-fee plans, mathematically speaking, you might actually be better off investing your money in a standard taxable brokerage account using low-cost index funds once you've captured the employer match.
And the most dangerous trap within the 401k ecosystem is the widespread adoption of target date funds, or TDFs. Let's tear into these, because I think a vast majority of people listening right now probably have their money in one.
Oh, almost certainly. They are marketed as the ultimate set-it-and-forget-it solution. You say, I want to retire in 2045, so you click on the Vanguard 2045 fund or the Fidelity 2045 fund, and you assume that as you get older, the fund managers are magically protecting your money by shifting it into safer assets. It sounds incredibly responsible. Why are they a trap?
They are a trap for two critical reasons: hidden structural conflicts of interest and a fundamental misunderstanding of their risk profile. First, the conflicts. Target date funds are often essentially funds of funds.
What does that mean?
The provider creates the TDF wrapper and then stuffs it with their own proprietary mutual funds. And investigations have shown that many brokers populate these TDFs not with their highest performing, lowest cost funds, but with their most profitable, bloated, high-fee mutual funds.
They use the TDF as a dumping ground for the products they need to sell to hit their revenue targets. It's a captive audience.
That is essentially institutional pay-to-play. But the second, far more dangerous issue is how they actually manage the risk, or what they call the glide path. People assume that if they buy a 2010 fund, by the time the year 2010 rolls around, their money is locked up in perfectly safe, guaranteed assets.
Right, because they are about to retire.
Exactly. But the data from the 2008 crash exposed a horrifying reality.
What happened to them during the crash?
In 2008, the so-called safest income-producing target date funds, these were funds designed for people who were already in retirement, relying on that money to buy groceries, plummeted by an average of 17%.
17% for people already retired.
Yes. And the funds designed for people retiring in 2010, who were just 2 years away from needing their capital, dropped anywhere from 25 to 30%. And the 2055 funds, which were supposed to be diversified, crashed nearly 40%.
Wait, if they were supposed to be safe and heavily weighted in bonds as retirement approached, how did they lose 30%?
Because in the years leading up to the crash, interest rates were relatively low. To generate attractive yields and mask their high fees, the fund managers altered the glide path and overloaded these supposedly safe target date funds with highly correlated high-risk assets.
Like what?
Things like junk bonds, emerging market debt, and risky equities. When the liquidity crisis hit in 2008, all of those supposedly diversified asset classes crashed simultaneously. The diversification was a complete illusion.
So the lesson here is that you cannot abdicate responsibility. You cannot just click a button with a date on it and assume a faceless institution in New York is optimizing your life savings. You have to look under the hood, you have to know the expense ratio, and you have to know what assets you actually own.
Which brings us to the core strategic pivot of this entire blueprint. We've mapped the jungle. We know to automate our savings to defeat our monkey brains. We know to avoid active managers to plug the 3% fee leak. We've fired the broker and hired a fiduciary. And we know not to blindly trust target date funds.
We've played incredible defense.
Right, we have the armor on.
But defense doesn't score points. We have a pile of capital. The ultimate question, the reason everyone is listening, is where exactly do we put the money? How do we construct a portfolio that actually grows but won't implode when the next 2008 happens?
The answer to that question revolves around two words that sound incredibly academic but represent the absolute holy grail of investing: asset allocation.
Asset allocation. It sounds like something a CPA mutters in their sleep. But the sources, especially the interviews with the institutional titans, treat this concept with profound reverence. Why is it so critical?
To understand its power, we have to look at David Swensen. Until his passing, Swensen was the legendary chief investment officer of the Yale University Endowment. Over his tenure, he grew the Yale Endowment from roughly $1 billion to over $31 billion.
Achieving returns that absolutely humiliated Wall Street.
Oh, completely humiliated them. And Swensen stated a mathematical reality that sounds like a paradox at first. He said that asset allocation explains more than 100% of an investor's returns.
Okay, you have to explain the math on that. How can a single variable account for more than 100% of an outcome?
It makes sense when you factor in the negative, destructive impact of human behavior. Asset allocation is simply the strategic blueprint of how you divide your total capital among different, distinct asset classes. What percentage goes into U.S. stocks, international stocks, long-term treasury bonds, real estate, gold, commodities, and so on. Swensen's point is that if you establish a rigid, disciplined asset allocation strategy using low-cost index funds, that strategy dictates your baseline market return.
Okay, so that gives you 100% of the market return.
Right, but the average active retail investor doesn't just hold the allocation. They try to time the market. They read a terrifying headline and sell their stocks at the absolute bottom of a crash. Then they watch the market recover, feel FOMO, and buy back in at the top. They pay a broker a 5% load fee to buy a hot tech fund that subsequently crashes. The average investor actively subtracts value through timing errors and exorbitant fees.
Ah, I see.
Therefore, a purely passive, disciplined asset allocation model accounts for more than 100% of the actual realized returns you get compared to the guy trying to aggressively trade his account.
It's that cognitive bias again. The sources refer to it as the Lake Wobegon effect, named after the fictional town in Garrison Keillor's radio show where all the women are strong, all the men are good-looking, and all the children are above average. It's a statistical impossibility, but surveys show that 93% of American drivers believe they possess above-average driving skills.
Exactly. And that exact same hubris infects our financial decisions. 93% of guys sitting in their living rooms with an E-Trade account believe they possess the analytical foresight to pick the next Apple or Nvidia better than the aggregate intelligence of the global market.
Which is just mathematically false.
Asset allocation is the mathematical framework that protects you from your own hubris. It forces you to diversify across asset classes that behave differently in different economic environments.
Okay, so we agree that we need a diversified mix of assets. But what is the optimal mix? This is where this book fundamentally altered how I view investing, because the author managed to sit down with Ray Dalio and actually extract the precise recipe for a portfolio designed specifically for the retail investor.
Yeah.
We mentioned Dalio earlier. Let's just reiterate who this guy is. He runs Bridgewater Associates. At the time of this publication, he was managing around $160 billion.
He manages the capital of entire nations. You literally cannot give his firm your money unless you have $100 million in liquid capital, and even then, he is largely closed to new investors. He's operating at a level of macroeconomic analysis that is almost incomprehensible.
And yet, he provided a specific exact percentage breakdown for an individual investor to replicate his firm's overarching philosophy. He calls it the all-seasons portfolio. I want to break down these percentages because they are going to sound completely counterintuitive to anyone who has ever listened to traditional financial media. Traditional advice usually defaults to a 60-40 portfolio, 60% in stocks, 40% in bonds. But Dalio's all-seasons breakdown is radically different.
It is entirely unorthodox by Wall Street retail standards, but the institutional logic behind it is flawless. Here's the exact breakdown Dalio provided.
Yeah.
He recommends 30% in U.S. stocks, like a broad market index like the S&P 500, 15% in intermediate-term U.S. Treasury bonds, 40% in long-term U.S. Treasury bonds, 7.5% in gold, and 7.5% in a broad commodities index.
Okay, I have to stop you right there and play devil's advocate, because if I take that portfolio to any standard financial advisor in America, they're going to laugh me out of the office. 30% in stocks and a massive 55% allocated to government bonds.
Yep.
The conventional wisdom is that bonds are for 80-year-olds trying to preserve capital, not for someone trying to grow wealth. Especially in an environment with volatile inflation or rising interest rates, bonds traditionally get slaughtered when rates go up. How on earth does allocating more than half my money to a historically low-yield asset class make any strategic sense? It sounds incredibly risky to me, like guaranteeing I will lose purchasing power to inflation.
Your reaction is exactly what 99% of financial advisors would say, and it completely misses the genius of what Dalio is doing. To understand this portfolio, you have to understand a concept called risk parity. The critical flaw of the traditional 60-40 portfolio is that it attempts to balance dollars. It puts $60 in stocks and $40 in bonds.
Right, which sounds somewhat balanced on paper.
It sounds balanced, but it ignores the concept of volatility. Stocks are inherently vastly more volatile than bonds. Historically, stocks are roughly 3 times more volatile, meaning they swing up and down with 3 times the violence of a treasury bond. So if you put 50% of your money in stocks and 50% in bonds, you might think you have a balanced portfolio. But because the stocks are 3 times as volatile, the risk in your portfolio is actually overwhelmingly dominated by the stock market. Dalio uses a brilliant analogy here. He says it's like trying to make a perfectly balanced smoothie using an apple and a jalapeno pepper.
I love this. Okay, break that down.
If you put 50% apple and 50% jalapeno in a blender, you do not get a balanced smoothie. You get a jalapeno smoothie that burns your mouth off because the spice profile of the pepper completely overwhelms the sweetness of the apple.
The stocks are the jalapeno.
Exactly. The stocks are the jalapeno. So to achieve actual mathematical balance, to make sure that a massive crash in the stock market doesn't obliterate your life savings, you cannot balance the dollars. You have to balance the risk. You have to significantly increase the volume of the less volatile asset, the bonds, to offset the extreme volatility of the equities. You need a lot more apple to balance out the jalapeno.
Okay, the risk parity concept makes sense. But it doesn't answer my question about the macro environment. What happens if inflation spikes? If we hit a stagflation scenario like the 1970s, bonds lose massive real value. Doesn't this heavy bond portfolio just get crushed?
This is where Dalio's macroeconomic framework comes into play. Dalio argues that there are only four possible economic seasons that the world can experience. The economy can either be growing or it can be shrinking, which is deflation. And prices can either be rising, which is inflation, or prices can be falling. That's it. Those four quadrants dictate the movement of all financial assets.
Growth, decline, inflation, deflation.
Right. And here is the secret. Every single asset class performs well in a specific season and performs terribly in another. Stocks perform brilliantly in periods of unexpected economic growth and falling inflation, but they get crushed during deflationary crashes. Treasury bonds perform exceptionally well during deflationary crashes like 2008 because there is a flight to safety and interest rates are slashed. Gold and commodities perform brilliantly during periods of rapid unexpected inflation, which is exactly when your bonds are losing value.
I see. So it's an interlocking mechanism.
Exactly. Dalio constructed the all-seasons portfolio so that you have 25% of your risk deployed into each of the four economic seasons. If inflation suddenly spikes and crushes your 55% bond allocation, the 15% you have in gold and commodities will theoretically surge in value to offset those losses. If the economy goes into a severe deflationary depression and your 30% stock allocation crashes by half, your 55% allocation in long-term treasury bonds will surge in value as interest rates plummet, offsetting the equity losses. You are dynamically hedged against all four macro environments.
It's an all-weather vehicle. And the empirical backtesting of this specific model is absolutely staggering. When they ran this exact percentage breakdown through 30 years of market data, from 1984 to 2013, covering multiple recessions, the dot-com bubble, and the 2008 crisis, the results were phenomenal. Over that 3-decade span, the portfolio made money 85% of the time. It only experienced 4 down years in 30 years.
But the truly miraculous part isn't just the win rate. It is the depth of the drawdowns. Let's look at 2008. The global financial system was literally days away from total collapse. The S&P 500 dropped by roughly 51%. The average investor saw their retirement account cut in half. How did the all-seasons portfolio perform during the worst financial panic in a century?
It lost 3.93%.
3.93%. While your neighbors are panicking, while Wall Street is begging for bailouts, you experience a mild temporary dip of less than 4%. You sleep like a baby. And despite that massive, impenetrable downside protection over that 30-year span, the portfolio still averaged an annualized return of just under 10% net of fees. It captures the vast majority of the stock market's upside, while completely amputating the catastrophic downside risk. It is an absolute masterpiece of portfolio engineering.
It fundamentally changes the emotional experience of investing. You eliminate the panic.
Right.
And that focus on downside protection is a perfect transition into the wisdom of the other titans profiled in the book.
Yeah.
Dalio's portfolio is a masterclass in structural defense. But what else can we learn from these billionaires? Because a recurring theme in these interviews is that the wealthiest people on Earth are actually the most paranoid about losing money.
That is the defining characteristic of the institutional titan. The amateur retail investor is obsessed with the question, how much money can I make? The billionaire investor is obsessed with the question, how much money can I lose and how do I prevent that from happening? We see this clearly with Paul Tudor Jones.
Yes, Paul Tudor Jones is legendary. This is the guy who anticipated the Black Monday crash in 1987 and made a massive fortune while the market collapsed. And in 2008, when everyone else was bleeding out, his fund returned nearly 30% positive. He is a macro trader. How does he construct his defense?
His strategy relies on a very specific, rigid technical metric. His primary rule for survival is that he will immediately exit any position or any asset class that drops below its 200-day moving average.
Okay, let's unpack the 200-day moving average for those who might not trade technicals. Why is this specific trend line so important?
A moving average simply tracks the average closing price of an asset over a set period of time, in this case, the last 200 trading days. It smooths out the daily noise and volatility to reveal the underlying macro trend. If the current price of the S&P 500 is trading above the 200-day average, the macro trend is positive. If the price crashes through that average and starts trading below it, the macro trend has turned negative.
And why do institutional algorithms and billionaires respect this line so much? Is it a self-fulfilling prophecy?
It is largely a self-fulfilling prophecy at the institutional level, yes. It is viewed as the ultimate line of demarcation between a healthy market and a sick market. Paul Tudor Jones doesn't sit around trying to fundamentally analyze if a crash is a buying opportunity. He doesn't try to catch a falling knife. If an asset breaks below that 200-day moving average, he liquidates his position and goes to cash. He ruthlessly amputates the risk because he understands the brutal asymmetry of mathematical loss.
The asymmetry of loss. This is another math concept that people completely fail to internalize until it happens to them. Walk us through the math of a drawdown.
If you start with a $100,000 portfolio and you experience a 50% loss in a market crash, your balance is now $50,000.
Right. And the amateur investor thinks, okay, the market just needs to go up 50% for me to get back to where I started.
But that is mathematically false. If your $50,000 portfolio gains 50%, you only make $25,000. You are now at $75,000. To recover from a 50% loss and get back to your original $100,000 baseline, you don't need a 50% gain. You need a 100% gain. You have to literally double your money just to tread water.
And a 100% return could take a decade to achieve.
That is why billionaires prioritize defense over offense. If you cap your losses at 5% or 10%, it takes very little upward momentum to recover. If you suffer a 50% drawdown, you have destroyed a decade of compounding.
Which is why the all-seasons portfolio capping losses at 3.93% in 2008 is so profoundly powerful. You never dig a hole so deep that you can't climb out. And the sources offer more nuanced advice on allocation, too. It's not just about setting it once and walking away forever. Mary Callahan Erdos, who manages over $2.5 trillion in assets as the CEO of JP Morgan Asset and Wealth Management, highlights the necessity of dynamic adaptation.
She emphasizes that your asset allocation must be a living, breathing framework that shifts in response to major life events. The allocation that makes sense when you are a 30-year-old single professional with high human capital and zero dependence is vastly different from the allocation you need when you are 50, married, with 2 kids entering college and a mortgage. As your liabilities evolve, your risk profile must evolve to match them.
And Sir John Templeton, one of the pioneers of global investing, reinforces our earlier point about the dietitian fiduciary. His core advice is essentially, know your limitations. He says, don't be your own investment manager. The modern financial system is simply too complex, the tax code's too intricate, and the algorithms too fast for an individual to optimize everything in their spare time.
Just as you wouldn't attempt to perform your own appendectomy after reading a medical journal, you should seek out legally bound, fee-only fiduciaries to help construct and maintain your financial architecture.
It is about delegating the mechanics to professionals who are legally aligned with your success, so you can focus your time on what actually matters. Which provides a perfect segue into the final and arguably most important phase of this entire framework. We've spent an hour dissecting the mechanics of wealth preservation. We know how to automate savings, how to plug the fee leaks, and how to allocate the capital defensively. But all of that addresses the management of capital. What about the generation of capital?
Yes, because this is the trap of the extreme frugality movement. You see these blogs telling people to cancel their Netflix, stop buying $4 lattes, and turn their thermostat down to 55 degrees in the winter to achieve financial independence. And while reining in excessive consumption is necessary, there is a fundamental mathematical limit to frugality. You can only shrink your life so much. Frugality has a hard floor.
Exactly. You cannot shrink your way to generational wealth. The input side of the equation, your earning potential, is theoretically limitless. So if you want to aggressively accelerate this timeline, you have to transition from a mindset of capital preservation to a mindset of massive value creation.
The sources are unequivocal about this. The fastest lane to wealth isn't cutting coupons. It is adding unprecedented value to the marketplace. It is an entrepreneurial mindset, whether you own a company or work inside a corporation. We see this today with the explosion of technology and AI. Look at a company like NVIDIA.
Oh, perfect example.
They didn't become one of the most valuable companies on earth by cutting costs. They identified a massive global bottleneck in computational power. They solved that problem with advanced GPUs, and the market rewarded them with trillions of dollars in market cap. Capitalism, at its core, is a highly efficient mechanism for rewarding problem solvers.
If you solve a minor problem for a few people, you get a minor reward.
Right, but if you figure out a way to solve a massive, painful problem for millions of people, you will generate a massive amount of economic abundance. The key is to constantly audit your own human capital. What skills are you acquiring that allow you to do more for more people in less time? How are you leveraging technology to scale your output?
But this pursuit of massive wealth creation forces us to confront the ultimate existential so what question of this entire deep dive. We've laid out a brilliant mathematical framework for hoarding, protecting, and compounding money. But the behavioral science and, frankly, the lived experience of countless wealthy individuals reveals a dark paradox. The sources cite studies demonstrating that money does not exponentially increase human happiness past a certain threshold.
It's true. Once you achieve a solid, stable, upper middle class income where your bills are paid, you have health care, and you aren't stressed about groceries, the correlation between additional millions of dollars and increased daily happiness essentially flatlines.
It is a phenomenon known as the hedonic treadmill. Human beings are remarkably adaptable. When you buy a massive mansion or a luxury car, you experience a sharp, intense spike in dopamine. You feel incredible. But within a few months, your baseline expectations adapt to your new reality. The mansion just becomes your house. The luxury car just becomes your commute.
The psychological thrill evaporates, and you find yourself chasing the next, more expensive hit of dopamine, perpetually unsatisfied.
So if acquiring more zeros in your bank account doesn't mathematically equate to more joy, why are we doing all of this? Why bother automating the savings and optimizing the index funds?
Because the behavioral economists didn't just study what fails to make us happy. They identified precisely what does. The conclusion isn't that money can't buy happiness. It is that money can buy happiness, but only if you deploy it strategically across 3 specific vectors.
Let's break those down. Vector number 1, investing in experiences over material possessions.
Exactly. The science shows that experiential purchases, a trip to Europe with your children, taking a master class to learn a new language, attending a concert appreciate in psychological value over time. While the new car rusts and depreciates, the memory of that family trip actually grows fonder and more significant as you age. It bonds you to other people and forms the narrative of your life.
Vector number 2, buying time.
This is perhaps the highest leverage use of capital. You use your financial independence to systematically outsource the tasks you despise. If you hate mowing the lawn, cleaning the house, or doing your taxes, you pay someone else to do it. You are literally purchasing hours of your life back, hours that you can now redirect toward your passions, your health, or building a new business. True wealth is having absolute sovereignty over your own calendar.
And vector number 3, which the sources argue is the ultimate pinnacle of wealth, giving to others, pro-social spending.
This is the philosophical core of the book. The author concludes that the fundamental purpose of life is to create meaning. And neurological studies confirm that meaning does not come from what you accumulate. It comes from what you contribute. When humans engage in altruistic behavior, our brains release a cocktail of oxytocin and endorphins that provides a far deeper, more sustained sense of well-being than any material purchase.
The author's own biographical narrative is the ultimate proof of concept here. He grew up in severe poverty. He recounts a Thanksgiving where his family had no money for food, and a stranger knocked on the door and delivered a basket of groceries. He took the profound emotional impact of that charitable act, used it as fuel to build an empire, and now uses his wealth to literally feed 50 million people a year through organizations like Feeding America.
It proves that if you simply hoard capital in a vault, you will likely end up emotionally bankrupt and isolated. The secret to living, truly, is giving. It forces a total redefinition of the word wealth. It requires the realization that true, lasting wealth is a matrix. It is financial, yes, but it must also be emotional, spiritual, and relational. If you have $1 billion but you have no time, terrible health, and no one to share it with, you are profoundly poor.
What an incredible synthesis. Let's recap the architecture of the master plan we've built today. We started by acknowledging the reality of the financial jungle, the high-frequency algorithms, and the zero-sum nature of active trading. We learned to bypass our evolutionary flaws, utilizing loss aversion to our advantage by automating our future savings into a freedom fund.
We identified the leaks in the boat, actively rejecting the 96% failure rate of active management and avoiding the massive hidden fees inside mutual funds and 401k plans by deploying low-cost index funds. We learned the vital legal distinction of hiring a fiduciary dietitian over a suitability broker.
We unlocked the institutional power of asset allocation, studying the risk-parity genius of Ray Dalio's all-seasons portfolio, a strategy designed not just to grow wealth, but to dynamically protect it against inflation, deflation, and devastating drawdowns.
And finally, we shifted our focus to massive value creation, recognizing that the ultimate purpose of this financial machinery is to buy back our time, invest in lifelong experiences, and generate enough abundance to meaningfully impact the lives of others.
It is a phenomenal, rigorous blueprint. But as we bring this deep dive to a close, I want to leave you, the listener, with one final speculative thought to ponder. Throughout this conversation, we've discussed the massive technological advantages of the insiders. We talked about the Wall Street supercomputers and the fiber optic cables terraforming mountains. It's very easy to look at that landscape and feel a sense of dystopian despair. It feels like the gap between the institutional titan and the retail investor is widening into an unbridgeable chasm.
It absolutely does. The asymmetry of technological power is staggering. But if we extrapolate the trajectory of this technology, particularly with the explosive advancements in artificial intelligence over the last few years, we might be approaching a massive inversion. What if the exact same technological explosion that Wall Street used to build those high-frequency algorithms is actually the catalyst that ultimately democratizes retail finance forever?
That is a fascinating pivot. Expand on that.
Think about the mechanics of what we discussed today. Identifying hidden 12b1 fees in a prospectus, executing tax loss harvesting, mathematically rebalancing a portfolio to maintain the exact risk parity ratios of Dalio's all-seasons model. These are highly complex, labor-intensive tasks. Historically, you had to pay a wealth management firm 1 or 2% of your net worth to do this for you. But AI is perfectly suited for this exact type of analytical processing.
Right, because it's just math and pattern recognition.
Exactly. We are rapidly entering an era where an AI agent acting as a legally bound digital fiduciary can instantly peer into your 401k. It can instantly identify the 17 hidden soft dollar costs. It can automatically fire the bloated active manager, seamlessly route your capital into Vanguard index funds, and dynamically adjust your asset allocation based on real-time macroeconomic data. And it can do all of this in milliseconds for fractions of a penny in computational cost.
So instead of the technology merely being a weapon wielded against us by institutional hedge funds, the technology becomes a frictionless tool wielded by us.
Precisely. You are essentially carrying a billionaire hedge fund manager, a CPA, and a fiduciary advisor in your pocket. The algorithms that were originally designed to rig the game in favor of the house might be the exact mechanisms that finally permanently level the playing field for the individual investor. The cost of bespoke financial optimization is driving towards zero.
I love that perspective. The tools for total financial sovereignty are being rapidly democratized and placed directly into your hands. But, and this is the absolute crux of the issue, having access to the tools is irrelevant if you don't pick them up. No AI, no algorithm, and no book can force you to take action. You have to be the one to make the psychological shift. You have to stop acting like a passive consumer, getting tossed around by inflation and fees, and demand to become an owner.
The information is no longer hidden. The blueprint is fully transparent.
Exactly. We started this deep dive by acknowledging that the financial world is not a fair, clean board game. It is a murky, complex, dangerous jungle. It is a game played with loaded dice, high-frequency robots, and invisible ink. But now you have the decoder glasses. You know exactly where the hidden leaks are in your boat. You know how to balance the jalapeno and the apple in your portfolio to survive any economic winter. And you know that the true secret to the game is simply to own the casino. You have the map, you have the machete, and you have the master plan. The only question left is, when are you going to take your first step?